Yes, volatility does not measure risk. And the problem is that the people who have written and taught about volatility do not know how to measure, or taught about risk, do not know how to measure risk. And the nice thing about beta, which is a measure of volatility, is that it's nice and mathematical and wrong in terms of measuring risk. It's a measure of volatility, but past volatility does not determine the risk of investing. I mean, actually take it with farmland here in 1980 or in the early 1980s, farms that sold for $2,000 an acre went to $600 an acre. I bought one of them when the banking and farm crash took place, and the beta of farms shot way up. And according to standard economic theory, market theory, I was buying a much more risky asset at $600 an acre than the same farm was at $2,000 an acre. Now people, because farmland doesn't trade often and prices don't get recorded, they would regard that as nonsense, that my purchase at $600 an acre of the same farm that sold for $2,000 an acre a few years ago was riskier. But in stocks, because the prices jiggle around every minute, and because it lets the people who teach finance use the mathematics they've learned, they have, in effect, they would explain this away a little more technically, but they have in effect translated volatility into all kinds of past volatility in terms of all kinds of measures of risk. And it's nonsense. Risk comes from the nature of certain kinds of businesses. It can be risky to be in some businesses just by the simple economics of the type of business you're in. And it comes from not knowing what you're doing. And it is, if you understand the economics of the business in which you are engaged, and you know the people with whom you're doing business, and you know the price you pay and is sensible, you don't run any real risk. And I don't think Charlie and I, certainly at Berkshire, I don't think we've ever had a permanent loss in marketable securities that was, what, 1% maybe? Half a percent of net worth. I made a terrible mistake in buying Dexter Shoe, which cost us a significantly more than 1% of net worth, where I bought an entire business then. But I was wrong about the business. It had nothing to do with the volatility of shoe prices or leather or anything else. It just was wrong. But in terms of marketable securities, I cannot recall a case where we've lost. I mean, we've done a lot of things in securities that had a very high beta. We've done a lot of things in securities that had a low beta. It just, the whole development of volatility as a measure of risk, it's really occurred in my, and it's been very useful for people who wanted a career in teaching, but it is not, we've never found a way for it to be useful to us. Charlie?
Well, it's been amazing that both corporate finance and investment management courses, as taught in the major universities, we would argue it's at least 50% twaddle. And yet these people have very high IQs. One of the reasons we've been able to do pretty well is that we early recognized that very smart people do very dumb things, and we tried to figure out why. And we also wanted to know who, so we could avoid them. And
we will not run big risks at Berkshire. Now, we will be willing to lose, as I put in the annual report, $6 billion in a given catastrophe, but our catastrophe business, run over many years, is not risky. A roulette wheel will occasionally pay off at 35 to 1. And that sounds like you're paying out an awful lot of money compared to the amount bet on one number. But I would love to own a lot of roulette wheels.
Yeah, we don't think in terms of, well, we think first in terms of business risk. The key to Graham's approach to investing is not thinking of stocks as stocks or part of a stock market. Stocks are part of a business. People in this room own a piece of a business. If the business does well, they're going to do all right as long as they don't pay way too much to join into that business. So we're thinking about business risk. Now, business risk can arise in various ways. It can arise from the capital structure when somebody sticks a ton of debt into some business, and so that if there's a hiccup in the business, that the lenders foreclose. It can come about just by the nature of the business. Certain businesses are just very risky. Back in when there were more commercial aircraft manufacturers, Charlie and I would think of making a commercial airplane, a big airliner, sort of as a bet your company risk, because you would shove hundreds and hundreds of millions of dollars out into the pot before you really had customers. And then if you had a problem with the plane, the company could go. There's certain businesses that inherently, because of long lead times, because of heavy capital investment, that basically have a lot of risk. And commodity businesses have risk unless you're the low-cost producer, because the low-cost producer can put you out of business. Our textile business was not the low-cost producer, and we had a fine management, and everybody worked hard. We had cooperative unions, all kinds of things, but we weren't the low-cost producer, so it was a risky business. The guy who could sell it cheaper than we could made it risky for us. So there's a lot of ways businesses can be risky. We tend to go into businesses that inherently are low risk and are capitalized in a way that low risk of the business is transformed into a low risk for the enterprise. The risk beyond that is that even though you identify such businesses, that you pay too much for them. That risk is usually a risk of time rather than loss of principal, unless you get into a really extravagant situation. But then the risk becomes the risk of you yourself. I mean, whether you can retain your belief in the real fundamentals of the business and not get too concerned about the stock market. The stock market is there to serve you and not to instruct you, and that's a key to owning a good business and getting rid of the risk that would otherwise exist in the market. You mentioned volatility. It doesn't make any difference to us whether the volatility of the stock market, is averages a 0.5% a day or 0.25% of a day or 5% a day. In fact, we'd make a lot more money if volatility was higher, because it would create more mistakes in the market. So volatility is a huge plus to the real investor. Ben Graham used the example of Mr. Market, which is we've used it. I've copied it in the report. I copy from all the good writers. And Ben said, just imagine that when you buy a stock that in effect, you've bought into a business where you have this obliging partner who comes around every day and offers you a price at which you'll either buy or sell, and the price is identical. And no one ever gets that in a private business where daily you get a buy-sell offer by a party. But in the stock market, you get it. That's a huge advantage. And it's a bigger advantage if this partner of yours is a heavy drinking manic depressive. I mean, the crazier he is, the more money you're going to make. So you should, as an investor, you love volatility. Not if you're on margin, but if you're an investor, you aren't on margin. And if you're an investor, you love the idea of wild swings, because it means more things are going to get mispriced. Actually, volatility in recent years is dampened from what it used to be. It looks bigger because people think in terms of Dow points, so they see these big numbers about plus 50 or minus 50 or something. But volatility was much higher many years ago than it is now, and you had the amplitude of the swings was really wild, and that gave you more opportunity. Charlie?
Well, it got to be the occasion in corporate finance departments of universities where they developed a notion of risk-adjusted returns. And my best advice to all of you would be to totally ignore this development. Risk had a very good colloquial meaning a substantial chance that something would go horribly wrong. And the finance professors sort of got volatility mixed up with a lot of foolish mathematics. And to me, it's less rational than what we do. And I don't think we're going to change.
Yeah, finance department teach that volatility equals risk. Now they want to measure risk, and they don't know any other way. They don't know how to do it, basically. And so they say that volatility measures risk. And you know, I've often used the example that the Washington Post stock, when we first bought it, had gone in 1973, had gone down almost 50%. From a valuation of the whole company of close to, say, 180 or 175 million down to maybe 80 million or 90 million. And because it happened very fast, the beta of the stock had actually increased, and a professor would have told you that the company was more risky if you bought it for 80 million than if you bought it for 170 million, which is something that I've thought about ever since they told me that 25 years ago, and I still haven't figured it out.